no, this is not the end of any gold bull market. What it is, it's more of the same thing, the stupidity of manipulating and rehypothecating both LBMA and COMEX contracts to drive the price down to maybe buy themselves some more time or to help cover their short positions that are growing very tenuous and bleeding them dry, them being the big bullion banks. So yeah, I think this is just a correction amidst a primary bull market.
When gold tops, it makes a high and doesn't come back to it. We've gotten over 2,400 3 months in a row, which shows that it's comfortable. You get back over there again, I think you're going to launch gold in a more dramatic way even, where you might be over 3,000 very rapidly, and silver like as well, leading the game. So silver's actually been stronger than gold despite the recent intra-month pullback in silver.
Yeah, I don't think there's anything they can do to stop the price appreciation. They can try to slow it, and I mean they've been doing that for years and years. We're now at the point where the physical markets are making price as opposed to the paper markets. I mean, there's a battle going on right now, and the winner will be the physical markets, and the loser will be a collapsed and defaulted paper market structure. My guess is, how do they prevent the little guy from becoming wealthy? I think it's a pretty obvious answer is what they're going to do is they're going to put a massive tax, who knows, maybe 90% on your capital gains in gold and silver.
In today's weekly recap, three financial experts, Michael Oliver, Andy Schectman, and Bill Holter, discuss the recent price moves in gold and silver and do a deep dive into the most relevant news of the week. We watched hours of interviews to bring you the best clips so you don't have to. There has been a ton of major moves in the macroeconomic landscape, and we'll cover them all today. But first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
If you look at silver's highs since 2020, just on a bar chart, not that chart I sent out, which is the monthly close only, but if you look at a bar chart, you'll see there was a brief spike above 30 that occurred in 2021, very brief. I don't think there are any monthly closes up there. And then you retreated sharply, whereas gold had flat ceiling, got over 2,000, 2020, got over 2,000 again in 2022, got over 2,000 again in 2023. So it had a flat ceiling. Silver, on the other hand, had descending highs. While gold was going sideways, silver made lower and lower highs. So that 30 was the topmost peak of the pattern of descending highs. In fact, its last set of highs that it broke through was at $26. So we haven't even pulled back to there, and I don't think you're going to. Okay. So pulling back below 30 is not technically important. That's one single isolated old high over there that lasted, I think, a week. Okay, but most of the highs in silver since 2020 have been in the mid to upper 20s, not at 30. So it's not technically important. I know a lot of people think it is, but it's not. And I strongly suspect that the pullback we had in silver this week was it. That was the low, I believe. That was 28.73. Right now we're trading 29.60 something as we do the interview. I think when gold gets above that 2,400 ceiling, that it's defined 3 months in a row, meaning it's a happy level. It's not thin air up here for gold. Thin air is like the 2011 peak. Go back and look at it. When you hit 1,920, you collapsed. You could never even get back to 1,800 after that. Okay. Then look at the 2020 high. In the year 2020, when we traded up to 2,070, when you dropped from that high, it took you 2 years to get back to that 2,000 level again. When you dropped, you dropped, okay? This time we hit 2,400, pull back, 2,400, 24. Something's going on here that says, no, it's not thin air up here. The market's quite comfy. So people who think it's overbought, I think are totally wrong. This is just a mild congestion zone. And when you get above that 2,400, especially 2,500, I think you'll see some drama that most people will be surprised by.
Physical markets are taking over as far as becoming the pricing mechanism. That's what's happening. There's a $30 to $50 premium in gold on the Shanghai over London, over the COMEX. And in silver, last week it got up as high as $4. So you're talking about more than a 10% premium in Shanghai versus COMEX versus London. And that is it's a slam dunk no brainer. You buy silver in the West, you demand delivery, and you sell it and then send it for settlement in the East. So yeah, the physical markets of Shanghai, of China, those physical markets are taking the pricing mechanism away from the West.
After covering the price action this week and the main situation in the Shanghai COMEX arbitrage, now Andy Schectman tells us what he's seeing in the bigger picture and ties both Oliver's and Holter's takes.
In the last 3 years, you look at a country like India as an example. The Reserve Bank of India just purchased 24 tons of gold in the first 4 months of this year, the first quarter plus, which is 1.5 times what they bought all of last year in 2023. We're seeing some very interesting things as well, in terms of the exchanges being bled down. And you look at, for example, what's happening right now off of COMEX just recently. 3 Fridays ago, we saw 7,560 kilo bars shipped out of the COMEX to Brinks, Hong Kong. Brinks, Hong Kong is a COMEX depository. And the conventional wisdom is that nothing goes to Brinks, Hong Kong that isn't what's called exchange for physical, where these traders can buy in the West and deliver in the East. Now, China is offering a very nice arbitrage opportunity for the traders who have the ability to access both markets. It's about $4 an ounce in silver, not so acute in gold, but ask yourself this question: who the hell's got $571 million to purchase 243,000 ounces delivered off of COMEX to Brinks, Hong Kong? And the belief is that they are then trucked over, because these are all kilo bars, and the Shanghai Exchange deals in kilo bars. The mini contract on COMEX is kilo bars. So some entity, and some people think it's HSBC Bank. I don't know who it is, but I can tell you that $571 million worth of kilo bars were delivered to Brinks, Hong Kong. Some people believe it's then being trucked to the Shanghai Exchange, which uses kilo bars. And when you talk about the amount of central bank purchasing, it's off the charts. And I don't think we're even being told how much these central banks are buying. But when you realize that not only are these banks accumulating gold, it is a trend of repatriation as well. And, the Bank of India just moved 100 tons of gold quietly out of the Bank of England and took possession of it. And you go back a few years, you start with the Bundesbank in Germany, the Dutch National Bank, the Bank of Austria, Hungary, Turkey, Poland. We just saw the Bank of Saudi Arabia, several African banks and a couple more Middle Eastern banks all pull their gold out of the Bank of England and the New York Fed. So it's about slow repatriation. It's about slow accumulation, not too fast to raise attention. But what I really do believe is happening is that the Western suppression of metals, as foolish as it is, which has originally been there to suppress the demand for gold in a low interest rate environment, which is obviously changing, they're using that suppression, the large short positions of the commercial banks, to drain the exchanges, to do exchange for physical, to drain the COMEX, to drain the LBMA, and now even pulling metal out of the Shanghai Exchange, because I think counterparty risk is something that is very acute. And the belief that wealth is found in a broke country's debt, our treasuries, or a country that has chosen to inflate versus being prudent with their fiscal policy, the monetary policies. I think we are moving to a period of time where the rules are being changed, I guess is what I'm trying to say. It's almost as if Gold and silver markets seem to be playing by a new set of rules, I guess is what I would try to say.
The silver market is experiencing a deficit for the third consecutive year. Michael Steinmann, CEO of the mining group Pan American Silver, talks about the robust growth in demand for the precious metal, declining global inventories, as well as the company's opportunities and challenges when it comes to new mining projects. Precious metals are attracting increasing interest. After a long sideways trend, gold and silver have come to life. Meanwhile, consolidation among mine operators is progressing. For CEO Michael Steinmann, it is evident that silver will play an increasingly important role in the modern economy, especially regarding the energy transition to renewables. However, while demand is increasing, supply capacities will remain limited for the foreseeable future. There will soon be very little inventory left, says the Swiss mining executive with more than 25 years of experience in the sector. Consequently, any uptick in investment demand coupled with ongoing industrial usage could create a particularly bullish scenario. It's important to point out that silver has two primary drivers: industrial demand and investment demand. Last year, investment interest softened quite a bit, similar to gold, where you could observe consistent outflows from gold ETFs. Yet the price of gold held up relatively well, and this strength can likely be attributed to significant gold buying by central banks. Strong and growing industrial demand, coupled with a resurgence of investment interest, has driven the price up to around $30 per ounce. Obviously, if the Fed keeps interest rates higher for longer, this will have a negative impact on gold and silver or any commodity, since higher interest rates typically lead to a strong dollar. Nevertheless, we see very robust prices. And by the way, not only regarding gold and silver, but also in the case of base metals. How are you currently experiencing investor interest in silver? We're in a good spot right now, but there's still subdued investment demand. Don't forget, we're only sitting at around $30 per ounce here, while gold and copper are basically at all-time highs. Historically, silver has seen peaks above $50, so we're still some way from that. Now we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
No, there's not fiscal tightening at all. I mean, if the Treasury is borrowing $1 trillion every 100 days, I mean, that's $1 trillion going into the system and being spent. Where it comes from, it basically comes from thin air. It comes from the Treasury issuing the bonds and, some market buying and a huge amount of Federal Reserve supporting the Treasury market. So from a fiscal standpoint, we're extremely loose. We're looser now than at any point in history. And I will understand the economy, and I'll talk about the United States. The real economy in the United States, I guess you could basically say, exists only because the stock market is providing, if you want to call it, wealth, the feel-good effect. People are still spending some money because of the stock markets, because of the financial markets. When the financial markets collapse, the United States is complete toast because we don't have any manufacturing to speak of. I mean, our manufacturing base has shrunk. Compare today to 50 years ago, we were the manufacturing king of the world. Yes. Now we don't manufacture anything. So without a robust financial market, the real economy collapses. And it used to be the other way around. It used to be that the real economy supported the financial markets and gave justification for pricing in financial markets. Now it's the other way around. Now it's the tail wagging the dog.
Political tensions such as the threat of war. So I don't think that's an issue. In fact, in my history of knowing gold since the mid-'70s when it was legalized, it's never really responded to a war event. There might have been a war event here or there, but it really wasn't part of a driving force behind gold. What drives gold, it's money. And when you depreciate the money units by which you value price gold, whether it's in euros or yen or dollars, and that unit of money is depreciating in value continually, gold goes up continually. It's as simple as that. And when you have a crisis that's pending, especially in certain asset categories that central banks don't want to see go down, stock markets, that's when they'll depreciate the money even more in their effort to put out the fire. They'll flood it with the new river of liquidity, lower rates and so forth, but mainly the river of liquidity. And you can bet they're going to do that. And the one spark that always gets them going is when their stock markets break. And I think that's what's pending. Now, I mentioned the structure on T-bonds on momentum. You don't see it so evident on price, but on momentum, we have this massive ceiling, which we've hit and hit and hit for 2 to 3 years now. And when you go through that, and you're going through it right now on momentum, you're going to launch.
What do you think of this week's recap? Are you bullish or bearish for the rest of the month? Post in the comments section your honest opinion about the whole situation. And if you're rooting for these experts to actually be right and have precious metals soaring before year's end, thanks for watching, and check this video right here because you'll love it. I see you on the other side.